Hello, good evening to all of you. Today I would like to discuss portfolio management. As we know that portfolio means the set of securities, and the securities we can purchase only when we save the money. It means what? After saving money from our earning, there is a need to invest. So investment in various types of assets is an interesting activities that attracts people from all walks of life, irrespective of their occupation, economic status, education, and family background. So when a person has more money than he requires for current consumption, he would be coined as a potential investor. Means what? If you have surplus money, then only you can save. If you are in deficit, you cannot save. So saving is possible only and only if you have surplus. And if you have surplus, than your current consumption, then you can turn as a potential investor. Now the question is, the investor who is having extra cash could invest it in securities or in any other assets like gold or real estates, or could simply deposit in his bank account. Is that clear? It means if you have surplus money, then you can invest your money in either in bank, or you can purchase some building, land, whatever, or you can purchase gold. Is that clear? So it means what? The companies that have extra income may like to invest their money in expansion, diversification, modernization, replacement of the old assets with a new one. It means what? If the company has extra income more than surplus, then what he will do? The company may expand the market, may diversify the product, may modernize the equipment, may replace the old machine with the new one. So, this is what the companies can do. All these activities, in a broader sense, means investment, either in the form of company or in the form of normal investors. Is that clear? It means what? Investment is the employment of funds on assets with the aim of earning income or capital appreciation. Investment has two attributes. What is that attributes? That is, the first one is time, and the second one is risk. What you are doing? You want to consume the money, or you have two options. Either you consume the money or you can save. If you consume the money, then you cannot save, obviously. But if you sacrifice the present consumption, why you want to sacrifice the present consumption? To save money, to get more return. Why? For future. Why? Because future is uncertain. So, and you have dream. Dream of what? Dream of good life, good education of your children, good marriage of your children, and so on and so forth. So, what you are doing, you are, instead of consuming your present income, what you do, you sacrifice. Why? To get a return in the future. This, if you are sacrificing, then what happened? This sacrifice has to be borne, is certain, but the return in the future may be uncertain. Because sacrifice that has to be borne is certain, because it's certain, but the return in future is uncertain, because you don't know how much return you are getting in future. So this attributes of investment indicates the risk factor. Because of uncertainty of return, maybe possibility 20%, maybe possibility 10%, maybe 2%, maybe no return. It means what? There is an indication of risk factor. The risk is undertaken with a view to reap some return. So you undertake risk. Why? To get better return. Why? Because you are sacrificing your present consumption. So, because you are sacrificing your present consumption, so why? To invest. Why? To get better return. So, there is one proverb that no risk, no gain. It means you are sacrificing for the future. So the risk is undertaken. You are taking risk with a view to reap what, some return from the investment. So investment means some monetary commitment. A person's commitment to buy a flight or house for his personal use may be an investment from his point of view. This cannot be considered as an actual investment. Why? Because as it involves sacrifice but does not yield any financial return. Is that clear? So person's commitment to buy a flat or house for his personal use may be an investment from his point of view, but they cannot be considered as an actual investment because it does not yield any financial return. That is not giving you any return. Now, I can say that economist point of view, what the investment means. Being an economist, investment is the net addition made to the national capital stock that consists of goods and services that are used in production processes. It means investment is what? Is a net addition, that whatever you are adding in what? In the national capital stock that consists of goods and services that are used in production processes. Net addition to the capital stock means an increase in the buildings, equipment, or inventories. So, these capital stocks are used to produce other goods or services. Is that clear? So, financial investment is the allocation of money to assets that are expected to yield some gain over a period of time. So, this is what financial investment. That is, you are allocating your money. Where you are allocating your money? To purchase plant, machinery, land, building. Why? For investment purpose, not for use purpose. Why? Because you are expecting yield, because you purchase land for investment to sell in future. You purchase some apartment to purchase to sell in future. So you are expecting some return, some gain over a period of time. It is an exchange of financial claims such as stock or and bond for money. These are expected to yield return and experience capital growth over the years. Those then the financial and economic meaning are related to each other because the saving of the individual flow into the capital market as financial investments to be used in economic investment. Even though they are related to each other, we are concerned only about the financial investment made on securities. So we are concerned only for financial investment which we made on securities. Now, there are investments are of three types. That is a normal investor. Second one is the speculator, and third one is gambler. Who is investor? Normal investor, the person who is expecting the normal return by investing the money into bank to get 5% interest, suppose. He's a normal investor. But other one is hoping to invest to get a higher return. And when you are expecting higher than the normal return, then what happens? It means you want to take risk. And that is a good saying, proverb is no risk, no gain. It means you want to take risk to get better return, better than the normal return. And when you expect better return, then from where you will get? You will get this better return, higher return, by investing your money in capital market. After purchasing the bond or shares or whatever. So it means what? It means you can invest your money in share market only when you have the full knowledge of the market. If you are not acquainted with the market, if you are not knowing the trends of the market, if you do not have the knowledge of the security market, then you are not supposed to invest your money in a proper box. Then you cannot expect a better return. It means the speculator has having the knowledge of the market. Then only the speculator will invest the money in the stock market and hoping to get better return, higher return. Third one is the gambler. Who is gambler now? Gambler is the person who walks like a blind, like a drunken person. It means the person who want to invest blindly, do not have the knowledge of the security market, do not have the knowledge of the financial market. Then where he is investing? Like the person who is investing money in casino, the person who is investing money in horse racing, and the person, that money who is investing in horse racing or casino, do not have the knowledge of this casino games as well as horse riding. Which horse will win the race, which number will get better return, that you don't know. It means the person who do not have the knowledge of these market are known as gambler. And there is a proverb is gambler is neither winner nor gainer. So These are the three types of investors. One is normal investor, one is speculator, and the third one is gambler. Is that clear? Now, what are the objectives of investment? Because you are investing your money, so you have to have the knowledge of investment, that why you are investing, what is the objective of investment. The main objective of investment are increasing the rate of return and reducing the risk, because you have two attributes, two terms, that is risk and return. So you can invest the money keeping into considerations two factors, risk and return. So good investors will invest the money keeping into considerations to increase the return and reduce the risk. And there are some other subsidiary objectives too. What is that subsidiary objectives? Subsidiary objectives are, you are investing your money, okay, fine, by taking into consideration that your money should be safe. Safety is important also. Where you are investing your money, you have to think about whether your investment is safe or not. Number two, liquidity. That is, at the time of emergency, whether you will get convert your stocks into cash without losing time or not. Third one, hedge against inflations. That is, at the time of inflation, whether your return is more than the inflation or not. So these are the subsidiary objectives. Now, we consider, because we are investing the money, so we have to have the idea about the return. So what is return actually? As we know that investors invest money hoping to get better return. So better return is possible only and only if you invest your money by having good knowledge of the market. So how you calculate the rate of return? The rate of return you can define as the total income the investors receives during the holding period, stated as a percentage of the purchasing price at the beginning of the holding period. So how we calculate the rate of return? Suppose we take the example. Suppose if we purchase the stock and purchase the stock, suppose at the rate of $50 or 50 rupees, suppose in the year 1998. And in 1999, the stock price in the stock market becomes 60. You want to dispose the stock at that moment of time. The stock which you purchase at 50, you will dispose at 60. So how much extra money you are getting? You are getting 10 rupees extra. Now, you are holding your stock for how many days? You are holding the stock for 365 days, that is 1 year. Because you are holding that stock for 1 year, so the company, the stock of which you purchase, is giving you, distributing 5 rupees dividend or $5 dividend. It means what? There are two types of growth. One is capital appreciation. How much capital appreciated? Capital appreciated from 50 to 60. It means 10 rupees capital appreciation. Plus 5 rupees is dividend yield. Dividend yield is 5 rupees you are getting, that is company is distributing 5 rupees to you. It means the return is how much? Return is 60 minus 50. What is 60? 60 is the ending price, that is the current price of the stock. You can term is at PT. And what is 50? 50 is the beginning price of the stock, that is PT minus 1 years back, T minus 1. T means suppose 1999, T minus 1 is 1998. So ending price 60, beginning price 50. This is your 60 minus 50, that is 10 rupees capital appreciation, plus dividend distribution. Dividend distribution is 5 rupees, that is dividend yield, divided by the beginning price, that is PT minus 1 multiplied by 100. It means the rate of return is 60 minus 50 is 10 plus 5, 10 plus 5 is 15, divided by beginning price is 50, that is 15 divided by 50 multiplied by 100, and that is what your rate of return is, 30%. Is that clear? Because 60 minus 50 is 10, 10 rupees is 20% of 50, because you purchase the stock at the rate of 50. So 50 rupees you are investing, 10 rupees you are getting at the time of disposing the assets, stocks. It means 10 rupees is 20% of 50, plus 5 is 10%. So 20 plus 10 is 30%. So 30% is your return, rate of return. So rate of return is 30%. Is that clear? Now, so this rate of return is what? That is capital appreciation plus dividend yield divided by purchase price multiplied by 100. This is your return. Now you come to risk. So what is risk? Obviously, risk comes into existence when you hope better return. It means there is a variation of return, and when the return varies, it means this variation of return from 5 rupees to 10 rupees, 5 rupees, suppose 5%, if the bank is paying you as return, but you are not satisfied with 5%, you want 15% return. So how you will get 15%? Obviously you have to take risk. And when you want to take risk, then maybe there is a probability to get 15%, 12% or whatever. It means there is a variation of return from 5% to 15% or 5% to 12%. So, because of the variation in return from 5 to 15, it is possible only and only if you take risk. Without risk, you cannot get 15% return. You cannot get more than 5% return. Because if you are investing your money into bank, then your return is 5% only, suppose. So to increase the return from 5% to more, you have to take risk by investing your capital, by investing your money in stock market, capital market. Is that clear? Now, liquidity. Liquidity, because you have this objectives also. Wherever you are investing, that you have to take into consideration the liquidity must be there. Because if at the time of emergency, if you are not been able to convert that stock into security, into cash, then it is useless. So you have to invest the money in that very securities, the marketability of that security will be very good. If the marketability is not good, then you cannot, your liquidity position of your company will not be good. Because suppose if you are investing your money in that security which is loss making security, loss making company, then what happen? Suppose after 1 year if you want to sell your stock, marketability cannot be good because nobody want to purchase the stock of that very company which is loss making. So at the time of emergency, if you want to dispose the stock, you cannot dispose. So liquidity position at that moment of time cannot be said as good. So marketability of the investment provides liquidity to the investment. So liquidity depends on the marketing and trading facilities. If a portion of investment could be converted into cash without much loss of time, it would help the investors meet the emergencies. I already told you that if the investors is not been able to convert that stock into cash without wasting time, you can say the marketability of that stock is not good. So marketability must be considered, that marketability of the company, marketability of the stock of that very specific company should be good. Then only you can convert the stock into cash without losing time. Is that clear? Okay. So stocks are liquid only if they command good market by providing adequate return through dividends and capital appreciations. So you can say the stock are liquid only if they command good market. If the stock's marketability is good, it means the company investors are eager, crazy to purchase the stock of that very company. It means what? Your return will be adequate. You will get better return, and there, if you will get better return, it means there is a good capital appreciation as well as the dividend. You will get better dividend also. It means if the if the marketability of the stock is good, then there is a good chance of capital appreciation as well as dividend yield, dividend growth also. Is that clear? Now come to hedge. Hedge against inflation. So as we know that there is inflation in almost all the economy, the rate of return should ensure a cover against the inflation. Means your rate of return is liable to be more than the inflation. So inflation is suppose 5%, then your return should be more than 5%. It means if the return is 7%, then only you will cover the inflation, otherwise you will lose the money. So your rate of return supposed to be more than the inflation. Is that clear? So the rate of return should be higher than the rate of inflation, otherwise the investors will have to lose in real return. So where to invest? Growth stock. Growth stock, the stock where there is a growth, will appreciate in their values over time and provides a protection against inflation. If the stock which do not have growth, obviously that will not cover your inflation. So you should invest your money in the growth stock. Then only your investment will be appreciated over time, and that will provide a protection against inflation. So the return this earned should assure the safety of the principal amount, regular flow of the income, and be a wedge against inflation. Is that clear? So your return which you are earning should assure the safety of the principal amount which you are investing. You have to have the impression in mind that your income should be regular flow of income, as well as you have to take into consideration that there is hedge against inflation. Next one is safety. Okay, so we should take the class number. Okay, we will close this one at this moment. Safety. So safety means what? Safety means you will invest your investment under the legal and regulatory framework. So selected investment avenues should be, suppose I am investing our money in that very securities which is not legally and which do not have any regulatory framework. Then what happen? If the company is not legal, if the company do not have any regulatory framework, and you are investing in that very company, it means your money is not safe. So what? If it is not under the legal framework, it is difficult to represent the grievance, if any. It means if something happen, then you cannot represent your grievances. Why? Because that company is not under the legal framework. Is that clear? So approval of the law itself adds a flavor to safety. So there is an approval of law that adds a flavor of safety. Even though they approved by law, the safety of the principal differs from one mode of investment to another. Investment done with the government assured more safety than with the private party. Obviously, if you invest your money in government company, then your money is more safer as compared to this investment in private undertaking. Because if your investment is in government securities, then the government companies, the public sector companies is more secured. Why? Because they are under the legal framework. But private companies, there are so many hidden information, so maybe your money is not safe, like JVG, like Peerless, like so many companies who overnight may flew away, and your all in the investment will be futile. So from the safety point of view, investment can be ranked as bank deposits, government bonds, UTI, non-convertible debentures, convertible debentures, equity shares, preference shares, and deposits with non-banking financial companies. So these are the safety point of view, and these are the rank. So first, your money is safe in bank deposits, thereafter government bonds, thereafter UTI, thereafter non-convertible, thereafter convertible, thereafter equity shares, preference shares, and at the end that you are depositing in non-banking financial companies. So at the last rank is non-banking financial companies. It means your money is not safe in non-banking financial companies as compared to your money is more safer in bank deposits. Is that clear? So that is the all at this moment about the introduction of investment. Thank you very much.